Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome back, everybody. Today, I am going to do a 2024 Seveney year in review and talk. This is for everybody listening, including our investors, people considering investing, or people wanting to understand what has gone on in the mortgage note space over the past year and what we're seeing. I recently recorded an episode in regards to what I got right and what I got wrong in 2024 based off of a recording I did a year ago. I also recorded a video of what I anticipate in 2025. So let's dive right in and start at a very high level of 7E. And I'm happy to say at this stage, we had a significant goal of trying to double our investor count over the past year. We came very close to that. We have now over 700 investors within the fund. Our reinvestment rate is very strong. And what I mean by that is people who start off with investment and have continued to invest within our Regulation A offering or our Regulation D, which again, that Regulation A has a $5,000 minimum. All that information can be found on our website under Offering Circular or the SEC website under Edgar. As a company overall, we grew by 50% as well, and we haven't finished a year. So a very strong year again that we've had. And I have to give credit to our team. And we have been a team that has been very consistent in regards to who have been members of our team. We've had very little turnover within our company, which is honestly very unusual for a startup. And when you have trust in your team and you build a bond and strength, it continues to build. And people, just like a sports team, the longer you're together, the better off you typically perform. And that's how I like to look at things overall at 7E. So that's a high level of a little bit. Let me dive more into assets, what we're seeing in the note space, what we're seeing overall in things this year for a lot of real estate funds was very challenging, especially those who are not on the debt side. As a company currently has no debt in place, we did not have to have any challenges with interest rates or loans being called that we owed. Our capital stack has remained consistent where no debt and investors' pref is essentially outside of expenses, right there first in that capital stack. So that has allowed us to continue to grow and continue to take advantage of continuing to buy a mix of performing and non-performing loans. As our portfolio has continued to grow consistently over the past year, we've also continued to adjust and reorganize our portfolio. As non-performing loans became performing, we would sell those off. When we started the fund, we started with, we grew over 100, 150 assets to start. And many of those were, had some lower balances to them because we wanted that broad diversity. As we've grown, our asset valuation or price of unpaid balance on loans has continued to tick up, which has allowed us to, replace 3 or 4 non-performing loans with one. So we fluctuate now between, 50 and 75 loans, which was consistent with where we anticipated on being. And next year will probably be, between, I'd say 60 and 100 loans is where I'm anticipating at this point in time. But it allows us to plan ahead, go forward, understand our diversification that we want to have within the fund. The other thing I'll mention on that asset management side of things is over the past year, I'll use the term the bid-ask spread And what I mean by this is what a seller wants versus what a buyer was willing to pay. At certain times is way off. And some sellers I know where they put out $1 billion a month, we're only having 20% of their loans trade hands because that spread was too much. And as time has gone on, insurance increases, taxes increase, and the cost of holding these loans has increased while asset values are not skyrocketing like they were in the last few years. That has had sellers change their tune. And let me explain at a high level why. If you're sitting on a loan that's worth $100,000 and the property continues to increase and interest continues to accrue, you're basically, hey, I'm still covered with equity, so let this thing at fault interest continue to accrue. Now, what's happened is, let's take that $100,000 asset. Now the property value isn't increasing. So every dollar you spend, now you're at a point where you might not get that back. If you're spending it to get it back with interest, okay. If you're spending it and it's not coming back, it's hurting your bottom line. So sellers might be more interested now in liquidating some of those assets. Also, I think a lot of sellers, especially institutional, have certain requirements on how much non-performing loans they can have on their books. And we started to see a lot of sellers look to diversify their portfolios to get some of that off their books over the past year. So again, something we've been able to, as Seveney, be very cognizant of. And again, I don't like to use the term take advantage of, but I'll use, say, very peculiar in the assets we want to buy. We still can cherry pick the assets that we want. For example, according to us in early December, we just closed on a nice loan in Texas yesterday. We've got another one we're closing in Oklahoma, both non-performing, that we've got at very good discounts. We're working on a nice performing loan to, again, balance portfolio in New Mexico. So we're continuing to see opportunities, but also able to select and cherry pick the opportunities we want, which has been something that we, from the outset, have always wanted to do and will continue to do. As part of that, and continue to work on the portfolio and the assets, as you continue to go, there's always lessons learned. And over this past year, what are some of the lessons that we have learned is effort and time to manage assets. And thankfully, when we model our assets, we are very conservative. And I think this has been another challenge in the note space and why we're also seeing a decline in competitors out there in our size range is because they underestimated the effort and the time, meaning the staff that's required to manage some of these assets, as well as the time it's taking. And for those who have listened to me in the past, I have never said there's going to be this big foreclosure wave coming down the pipeline. I did think that we would see an uptick in bankruptcies. We clearly have seen an uptick in bankruptcies. We've seen it in our portfolio. Why? Because people have equity. They have no place to go. And bankruptcy's probably their best option. Now, for us, we model things based off of worst case scenarios, which when people have equity, bankruptcy's sometimes a worst case. And I see people who think, oh, I'm just going to foreclose on this asset and get it done within 6 months. We might model it 18 months because of, bankruptcies and everything that's involved. That's going to give you a very different price point. And being conservative for us, we fortunately did not learn the hard way from this. It's what we anticipated and what we continue to model and be going back to cherry picking, very specific on those types of assets. We've also been able to focus again, and I apologize if a lot of this is repeat stuff, because it's something that I am passionate about and something that is how we look at managing a business, which is, again, focus on that cherry picking, but not chasing the shiny object. When people ask, oh, will you consider getting back into multifamily, which is my background for many years? Will you consider other asset classes? Our answer has always been no. We are a note fund. We are a note company. We're going to buy performing, non-performing loans. Our loan strategies, again, always adjusting, which you have to. I like to always use the analogy of a football game, and the rules may change slightly by the referees or your opponents might change, whether it's a borrower or other companies, that you make in-game adjustments. And that is crucial in managing any type of fund and any type of asset portfolio. What we're not going to do is go from a 1980s Nebraska wishbone offense to the run and gun offense, which to me is, again, most people probably don't know what that is, but if you're an old guy like me and you're a college football fan, you would know what that is. But I think it's important to understand we stay in our lane. We stay what we're focused on. We're not going from notes to multifamily to self-storage to Bitcoin to commercial office to pick your short-term rental, pick your flavor of the day. It's not something we're going to do. We're not interested in chasing that shiny object. As a company, and we've reiterated this in the past as well, people always ask us the interest rate environment. How is that impacting the company overall? And as we mentioned in the past, really we're interest rate agnostic. Interest rates, the loans we buy are typically fixed, and we are buying based off of a yield. Interest rates float between 4 and 7%. The impact that does have on us is primarily based off of borrowers' ability to refinance. When rates go down, we see more refinancing on our loans. Great for us. If they don't, then it doesn't have a major impact because it goes back to how we model our loans. We model as if we're holding them to perpetuity, meaning to maturity, which I don't know how many actual borrowers truly do hold the loan for 30 years. Now, if it's 3%, yeah, they're probably going to as long as possible. But I don't think we have one loan in our portfolio that's less than 3% unless it was a mod, from that standpoint. So those are some of the areas that we've seen. We hope you're enjoying this episode of Creating Wealth Simplified. We wanted to take a moment and tell you more about our passive income fund at Seveney, which is open to both accredited and non-accredited investors. Our latest offering targets an 8% annual return distributed monthly with the ability to potentially achieve a greater return through our bonus share program. If you'd like more information, reach out to us at invest@seveneyinvestments.com to learn more. Thank you. And as we move forward into next year, so I talked about kind of what we've been through this year. I'm going to record a much longer episode of kind of my predictions on things. But, I'll just talk more specifically about 7E than diving too deep into the markets. But as we mentioned in the past, we are seeing billions of dollars of loans per month. We see more loans that we could acquire than we do have funds. So people will ask, hey, if somebody cut you a check for $10 million tomorrow or $50 million, how would that impact you? And it's a conversation we'd have with people in regards to deploying that capital. But we always go back to, we are such a small speck of sand in a $13 trillion industry for where we are. We are, as a company, roughly raised around $35 million to date. So when we look at overall that number, and if we're buying a few $1 million a month and we're seeing over $1 billion a month, now it's less than 1% of the assets. We're also seeing over the last several months a much broader diversification of assets that we're seeing. We are seeing loans, some defaulted investor loans, which have some opportunity, but have to be very selective on those. We are seeing some reverse mortgage loans, and that those are loans that you would have to foreclose on. So it's something we look at, but it's not a primary function or focus of our business. But we had to foreclose and we've had to go through that process. It's something we're familiar with, but it goes back to the concept of being very conservative. And when we're ultra conservative, a lot of times on those things, we might not be competitive. That's okay. It's not as if we're, again, having issues pulling this capital to get into loans. On the performing side of things, continue to add some performing loans into the portfolio for that cash flow. Those have been very good for us. Sometimes those are short-term loans, so it allows us greater flexibility in rebalancing the portfolio. That's always important that we have that non-performing performing ratio and mix, that we continue to kind of like a tennis match or pickleball, whatever your cup of tea is, the back and forth of truly balancing that portfolio to manage risk and the returns. The residential non-performing loans right now, last year was down. It's starting to pick up a little bit. We still see those loans. We're still, of course, buying those. Those are what we typically base everything off of, but they've been a little more challenging, which again, as I mentioned, we've seen the decline in competitors because they haven't seen a lot of those. And also a lot of people who were doing those, again, were getting burnt because of some of the timing. And as we continue on today and next year, we're starting again see that uptick and more of those loans coming on the market. I believe that is based off of increased unemployment, decrease in savings, people who have credit cards, at 28%, I think is what I saw some of the rates now on credit cards, which to me is completely insane. But people are struggling. And I think there's a vast majority, which again, I've reiterated this before, there's rumblings out. And again, I can't confirm whether this is true. I'm just telling you what I've heard, that 50 to 70% of Americans live paycheck to paycheck. If that's the case, temporary job loss, a significant increase, taxes, insurance, or credit cards, that's going to hurt. And we're seeing that in Texas, in Florida, seeing it in other areas. And that's where we're seeing some increases in some of these defaulted loans. So lastly, talk about, as our portfolio, home prices, because home prices are a significant risk and how we manage that risk profile. And it can be challenging. And I have been a proponent of, I think home prices are high. I think they have topped out for the time being. And I think they will soften. I'm not saying they're going to crash, but I think you're going to see some softening. And if they do soften, what's your loan to value? And this is something, again, as a company, we strive to focus on maintaining a loan to value that is in line with the risk profile. You've been on any of our webinars. You always hear us say we like to hit singles, doubles, and occasional triple. We're not a home run hitter. We're not a strikeout hitter. That's not what we're going for. We're not going for all the guts, all the glory within our portfolio. We look for loans that have that equity protection. So if there is softening, we look to protect our investors and preservation of capital. That's kind of something that I look for, is how can I manage preservation of capital? That's what we look for. So hope you enjoyed this video / podcast in regards to 2024, highlighting some of the places we've been, a little bit of what we're seeing, talk a little bit more about our company in general. But as always, if you have any questions, reach out. Go to our website, seveneyinvestments.com. Email us at invest@seveneyinvestments.com. And we are happy to answer any and all questions. Thank you. Take care. Happy holidays, and hope you have a happy new year. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.